I'm your chair, Shumit Chowdhury, and I'm delighted that you're all able to join us today for what I hope will be an interesting run through of some material that we'd like to take you through. If you just go to the next slide, please. Now, a focus of recent months for the kind of economist community has been the impact of kind of escalation in the Middle East, and that's the extent to which energy prices are higher than they would have been prior to that conflict, but also for how long that will take place. The other bit is around the inflationary impact of these higher energy prices, not only from a kind of direct effect through higher energy prices, but also indirect ones through intermediate inputs. And then, of course, the second round effects. And these are some of the major uncertainties that kind of policymakers and forecasters are looking through, but also us as a National Statistical Institute. So Amy will be taking you through some of that material later today as part of her State of the UK Economy, where she'll go through some of the latest intelligence that we have, which hopefully provides some insight as to some of those impacts. We've then got 3 updates that we're keen to take you through, and some of these you would have seen in some form over recent years. The first one is an update on our public services productivity review, which you may recall was published in March 2025, which set out a series of recommendations. Just over a year later, Bethany's going to take you through some of the work that's been done in that time and give you a little bit of an update on some of those kind of key aspects there. The second update you're going to hear is from Alexander. We speak a lot about the state of the public finances in the UK, where we typically focus on public sector net borrowing or public sector net debt. But what we also recognise is that it's actually quite tricky to navigate your way through the public finances, particularly in government expenditure. So he will take you through a piece that we've published today that's really there as an explainer to kind of help help cover some of what it is that the UK government spends its expenditure on, and it will show that how that's changed over time. And then the third update we'll have from Nathaniel, which will look at some of the trade flows that we have with the United States, where we know there's been quite a lot of uncertainty with global trade policy. So we'll take you through some of those trade flows that we've seen in recent times. As always, there'll be time for Q&A. So if you just go to the next slide. The Q&A will be done via Slido. There's been a link posted in the Teams chat function, so you're welcome to join, and it should take you straight to it, but it's also code 32776, and I'll get through as many as I can in the time that we have. And just to kind of reinforce that we're kind of keen to get your engagement in this, so we'll be using the hashtag ONS Econ Forum if you kind of wish to share any of the materials that you see today. If you could just go to one more slide. From my perspective, and it's just a reminder that in response to feedback, we will be recording today's economic forum. This will cover the kind of speakers material, and then we'll pause the Q&A, and then I'll get through as many of those as I can through the Slido, and then the recording will be hosted on our kind of YouTube channel. I think that's all in the form of housekeeping from me. I'll just go to the next slide, where I'm going to hand over to Amy, and enjoy the next hour or so. Thank you very much.
Thanks, Shumit. Good morning, everyone. My name is Amy Ditchfield, and I'm head of the Economic Analysis team for Prices and GDP at the ONS. And I'm going to take you through some content on the state of the UK economy today. Next slide, please. So I'll start by looking at the impact of higher crude oil prices and how these are likely to feed through to CPI. The recent conflict in the Middle East has led to rises in the price of crude oil. The price of Brent crude oil increased significantly in March and was trading as high as $127 per barrel on the 2nd of April. Having then dipped, recent tensions have meant that by the start of May, Brent crude oil was trading around $121 a barrel. This is high compared to pre-conflict of around $70. The chart on the left shows that this directly feeds into higher prices at the pumps for both petrol and diesel with a 2-week lag. Higher oil prices have direct effects on electricity and gas and fuels and lubricants. This is being reflected in our consumer price statistics, with the CPI for liquid fuels up by over 95% in March compared to last year. There are also indirect effects of higher energy prices on inflation, shown in the chart on the right. The chart is taken from the latest monetary policy report by the Bank of England and represents their estimated contributions of the indirect effects of energy prices to annual CPI inflation. The bank estimate that the pass-through of indirect effects will be quickest in the near term for food prices, shown by the green bars, then core goods, shown by the blue bars. There is a greater lag on the impact on services inflation, where this is expected to happen from August 2026, shown by the emergence of the purple bars. Next slide, please. So moving on to inflation expectations, the chart on the left shows households' expectations for 1 and 5 years ahead, whilst businesses' expectations are for 1 and 3 years ahead. Households' inflation expectations are higher for both the short and medium term than they are for businesses. In February, households' 1 year ahead expectations were at 3.3%, but by March, this was as high as 5.4%. Whereas for businesses, short-term expectations remained at 3.1% in February and March. Since then, households have lowered their expectations slightly to 5.0%, whilst businesses increased slightly to 3.5%, but still remain way below those of households. Whilst the time series shows that households have generally had higher inflation expectations than businesses in the last 3 years, we can see a more pronounced impact of conflict on households than firms. There is evidence that households form their future inflation expectations in a backward-looking way, so if inflation has been high in recent months and they remember high inflation from previous conflicts, then this could be an explanation. Food accounts for 11% of the overall consumption basket of UK households, so this can have an outsized effect on households' inflation expectations too when this is elevated. Households are more sensitive to news stories than businesses, primarily because consumers have limited indirect information about overall price trends, whereas businesses have direct daily access to supply chain and cost data. Daily news stories of hikes in oil and gas prices may therefore have contributed to the rise in household inflation expectations. The chart on the right shows data from the ONS Business Insights and Conditions Survey, also known as BICS. This shows the proportion of businesses that believe future sold prices will increase, which has been increasing since March 2026. 17.5% of businesses in March thought their future sold prices would increase, which rose to 21.5% in April and a further rise in May to 27.6%. This is the highest reading since January 2023. Next slide, please. However, if we look at the labour market, the economic environment today is markedly different from what the UK labour market was like in 2022 when the conflict in Ukraine started. These differences could suggest that broad-based inflation and second-round effects could be less likely with the most recent conflict. In 2022, the labour market was tight as firms adjusted to residual post-pandemic demand pressures. Firms responded to elevated inflation and rising living costs by offering relatively strong pay increases, which contributed to the emergence of an upward wage price dynamic. This wage price spiral became an important channel through which inflationary pressures, initially driven by the 2022 energy shock, fed through to services inflation. The tighter labour market in 2022 can be seen in the chart on the left, where the vacancy rate was high and the unemployment rate was lower. We have a weaker labour market in 2026 with a much lower vacancy rate and a higher unemployment rate, despite a slight easing from February 2026. This means that employers have more control over wage setting, potentially reducing chances of an inflationary wage price spiral and therefore not weighing on inflation as it did in 2022 following the previous energy shock. This is illustrated in the chart on the right-hand side, where we can see that earnings growth had been high and despite still being strong, it has eased in recent months, and private sector regular wage growth, which the bank sees as an indicator of underlying inflationary pressure, slowed to 3.2%. This represents a substantial decline from peak levels seen in 2023 and also contributing to lower potential inflationary pressures. Next slide, please. The chart on the left shows how firms expect rising energy prices to affect their businesses over the last year. Overall, firms anticipate the strongest impacts to be higher output prices and increased labour costs. Firms are expecting for these to feed through into lower profit margins over the coming year. Turning to the chart on the right, this shows the proportion of energy prices that are currently fixed or hedged, broken down by firm size. 46% of firms with 250 or more employees report having none of their energy prices fixed or hedged. This compares to around 30% across all businesses and is the single largest category, suggesting that larger firms may be more exposed to energy price volatility. More broadly, ONS data and the Bank of England's calculations indicate that nearly 60% of all firms have some sort of fixed price contract for gas, with a similar share for electricity. These proportions have increased somewhat since 2022. It's important to note that contract lengths vary. This means the impact of energy price changes will take time to fully pass through to many firms. Next slide, please. Thank you. Moving on to economic growth, last week we released our first quarterly estimates for 2026 Q1, where we saw strong GDP growth starting the year with growth of 0.6%. This pickup in Q1 is relatively broad-based with positive contributions from services, production and construction. However, services still dominates the growth picture, reflecting its large weight in the economy. Services had a 0.8% growth in output, whilst production output grew by 0.2% and construction output by 0.4%. The chart on the left shows that there has been a clear acceleration of 3-month on 3-month growth from November onwards, suggesting some growth momentum as we headed into 2026. The chart on the right shows that for the services sector, which typically makes up for around 80% of GDP, there was a rise in output in 11 of the 14 subsectors in 2026 Q1. The wholesale and retail trade, repair of motor vehicles and motorcycles subsector was the largest positive contributor to services output growth. Growth in this subsector, along with growth in information and communication and professional services, indicates that both consumer and business-facing services contributed to growth at the start of this year. Next slide, please. These two surveys show how pressure from the current economic situation is feeding through to UK businesses and household sentiment. Starting with the CBI Industrial Trends Survey on the left, businesses are reporting a contraction across the board. The number of people employed in the past 3 months is falling, output volumes are down over the past 3 months, and crucially, domestic prices are rising. The latest consumer confidence reading of -25.4 is the lowest since October 2023 and worse than market expectations. The sharp downturn reflects deepening concerns over the economic fallout from escalating Middle East tensions, with pessimism spreading across both personal finances and the broader UK economy. However, concerns of the general economic situation are stronger than their own financial situation, with the latest reading for the general economic situation being -43 compared to just -4 for their own financial situation. Next slide, please. Thank you. Finally, I'll provide an update on public finances. Gilt yields fell to record lows during the pandemic, but have risen sharply since 2022, reflecting higher global interest rates and persistent inflation. On Friday, 10-year gilts hit 5.15%, which is the highest level since 2018 and close to an 18-year high, whilst 30-year yields are at levels last seen in the late 1990s. The recent rise is likely representing a combination of factors, both domestic and international. Geopolitical risks, including developments in the Middle East, may be contributing through their impact on energy prices. UK gilts have moved above other G7 economies, reflecting elevated inflation and sensitivity to energy prices in the UK, where we're more exposed to international energy shocks compared to other G7 countries. Turning to the fiscal position, public sector net borrowing is required when public sector expenditure, current and net investment, exceeds receipts. This has continued to be the case during the 2024-25 financial year. Higher gilt yields are expected to increase the cost of financing new government borrowing. Later in this forum, Alexander will cover general government spending, which is a key component of the overall fiscal picture. Next slide, please. So to summarise, higher energy prices are expected to feed through CPI via goods, food and services prices. Weaker labour market compared to 2022 may limit second round inflation effects from higher energy prices. Strong growth in 2026 Q1 was largely driven by services, but supported by growth in production and construction. And 10-year UK gilt yields are at the highest level since 2008 and expected to increase the cost of financing new government borrowing. That's everything for me. Thank you. I'll hand to the next presenter.
Hello, I'm Bethany Hughes and I lead the annual Public Service Productivity team. And today I'm presenting a summary of the productivity review and our recently published Public Service Productivity estimates. Next slide, please. So public service productivity estimates capture changes in inputs, outputs and quality, also called outcomes. So for a hospital, inputs would include things like staff, building, equipment and materials. Outputs would look at things like number of operations, and then quality is looking at whether those operations were successful and what the outcomes of those were. Public service productivity is challenging to measure because we don't have market prices. And when measuring output is not possible, an outputs equal inputs convention is used. And when this is used, it means that public service productivity change is always 0. There's no change because inputs over outputs just equals 1. And this was previously the dominant approach in public service productivity. However, the gold standard is to use quality adjusted outputs where possible to calculate public service productivity, and that is something we are largely moving to. In June 2023, the Chancellor of the Exchequer commissioned the National Statistician to conduct an independent review of how public services productivity is measured and how it could be improved, and the findings were published in March 2025. From this, there were 120 recommendations in the report, of which 33 have now been completed. In the last 2 years, we have measured tax, administration and police productivity for the first time. Previously, they were just inputs equaled outputs, and we have made improvements across multiple surface areas, especially in outputs and the quality estimates. Next slide, please. For our annual publication, we publish on a roughly 2-year time lag. So this year we publish results for 2023. We publish the breakdown of 11 distinct service areas. And in this chart that you can see here, you can see the different makeup of the outputs type by service area, with the majority of areas having mostly quality adjusted output, while other government services, defence and immigration currently remain as inputs equals outputs. Healthcare and education make up the majority of public services by their expenditure share, and we published police and immigration separately for the first time this year in March 2026, with outputs as well for police. Next slide, please. For annual estimates, we published a time series back to 1997. Total public service productivity fell 14% in 2020 as inputs surged and the structure of outputs changed during the COVID-19 pandemic. Since then, productivity has increased, but recovery has slowed. Total public service productivity in 2023 was 1.3%, which is 4.1% below pre-pandemic 2019 levels. The average annual total public service productivity growth in the decade to 2019 was 0.7%. So the 1.3% we saw in 2023 was better than the average in that decade. And labour inputs have continued to grow for most service areas in 2023, whilst the spending on goods and services that we saw a big increase in during the pandemic is generally continuing to wind down. Next slide, please. So for police and immigration, the combined police and immigration index for 2023, I'm just looking at inputs, grew by 7.2%. Whereas separation of police and immigration show that there's a steep growth in immigration and citizenship inputs, whereas there's much more of a modest growth in policing inputs. So for immigration and citizenship, we see growth of 20.6% in 2023, whilst inputs for policing grew a more modest 2.8% in 2023. This shows the real value of separating out police and immigration to better understand the different drivers in their productivity. Next slide, please. This year is the first time we publish outputs for police and therefore non-zero productivity growth. We publish non-quality adjusted outputs, including for crime investigation and selected public safety and welfare activities. The other section of our outputs is crime prevention, and this remains inputs equals outputs as it's difficult to measure the output of that. Policing non-quality adjusted output grew steadily from 2019 to 2023. Initially, inputs grew faster than output, but post-pandemic, we see growth in outputs exceed inputs, giving us positive productivity growth. Police productivity grew 2.1% in 2023, and was 2.6% above the 2019 levels. This is one of only 2 areas that are above pre-pandemic levels, with the other being Social Security Administration, whereas the rest, their productivity all remains below the pre-pandemic level. Next slide, please. Alongside our annual publication, we publish a quarterly publication using some more timely data. These are official statistics in development and provide a more timely view of public service productivity. Early annualized estimates suggest that the total public service productivity growth remains subdued, growing 0.4% in 2024 and 0.6% in 2025. Overall, the total public service productivity in 2025 is estimated to be 3.1% below the 2019 levels, and growth is slightly weaker compared with pre-2019 trends, suggesting a slowing down of recovery and a longer road to returning to the 2019 public service productivity levels. Next slide, please. Looking ahead, we are continuing to develop our methods and implement the recommendations outlined in the productivity review. For quarterly publication of public service productivity, we are working on improvements to post-pandemic seasonal adjustments, the deflators that we use, and we're reviewing the health adult social care, introducing a policing quality adjustment, and are considering options to be used for the immigration output. Public service productivity remains a hot topic, particularly in health, but also across all service areas. And the new system of national accounts, the international framework published by the UN, makes clear this is a priority for national accounts improvement. And at ONS, we are world leading in our developments in this area and are continuing to look to go, how can we implement more improvements? That's me finished. So next slide.
Thank you, Bethany. My name is Alexander Smith. I'm in Public Sector Finance and Economic and Microdata Insights at the ONS. I'm going to talk through the release that we're doing on an explainer on government expenditure. Next slide, please. So this is the main, just going through where this release came about. So in this article, what we do is explain the types of general government expenditure and their trends over time, including current and capital expenditure by central and local government. We look at how this spending has changed since the late 1990s in the UK, including its composition. This does not include expenditure made by other public sector subsectors, though, including the Bank of England and the non-financial public sector corporations, for example. And we hope that this will help to provide clarity in how government has spent taxpayer money and other receipts. It's also an important area because changes in total expenditure have affected the amount that government has needed to borrow, and government being a net borrower since 2002, as its expenditure has been higher than its receipts. So what this chart shows is that general government expenditure as a percentage of GDP has generally risen since the late 1990s. And we see that in the late 1990s, total expenditure was around 36% of GDP. And this has increased to 46% by 2024, as shown by the line on top of the stack area here. And what we do in this chart as well is break down that spending by subsector, by central and local government. And with the dark area at the bottom shows that central government total expenditure has increased in proportion. So central government expenditure has been a key driver of these changes in total government expenditure over time. By contrast, local government expenditure has been relatively more stable, typically ranging between 2 to 3% of GDP over these years. And on the next slide, we're going to look at the same composition, in terms of total government total government expenditure, as shown by the blue line on the top of this area chart. But what this shows is that the breakdown by current and capital. So dark blue area here, so current expenditure has been the key driver of these increases in total expenditure over time. And again, we show that capital expenditure, I should say that current expenditure is those spending on day-to-day costs of providing government services, whereas capital includes spending on assets, for example. So what we see here is that the light blue area on capital expenditure has been more stable over time, typically ranging between 2 to 4% of GDP, albeit this has ranged between 4 and 6% in up to 2024 in recent years. So moving on to the next slide, please, Imogen. So in the next slide, we break down that the current expenditure into its components and how we measure this on government expenditure. So what this shows is that current expenditure on intermediate consumption and social transfers in kind have increased in turn since the late 1990s, and therefore driving some of the trend in the increase in total government expenditure over time. The three lines at the top, the blue and the orange and the green line, show what the main, the largest components of current expenditure have been. So the blue line being social benefits over social transfers in kind, which has generally been quite high over these years, towards 13 or even 14% of GDP in recent years. We've got compensation of employees as the orange line. So this is directly the compensation of payroll employees by government. But there's also intermediate consumption, and you can see this. However, this is actually quite a stark increase, and this has increased from less than 6% of GDP in the late 1990s to around between 8 and 9% of GDP in recent years. And intermediate consumption is that spending on the intermediate inputs used by government to produce and provide government services and goods. We're going to dive into some of the other drivers for this on the slides coming. But I think one of the two other things that I'll just point out from this interesting chart are the green line, which has the light blue green line at the bottom, which has a huge spike in 2020, up to almost 6% of GDP, and this represents subsidies payable by government. And you can think of what was happening around this time around the job retention scheme, for example, which is a key was one of the key spikes in that. Now, also the look at the light blue line, if you would please. So this is property income interest payable, and the overwhelming majority of this expenditure type in the UK is around debt interest. And this is, as you can see, this light blue line has ranged between 2 and 3.5% of GDP, typically over time, albeit peaking at 4.2% of GDP in 2022, and this is marked by a period of higher gilt yields, which increased the cost to government of refinancing debt, and also in a higher inflationary period as well, meant that the index-linked bonds or gilts, the cost of accrued interest on those increased as well. But interestingly, it has dipped down back towards historic levels since 2023, and as you can see, back under 3% by 2024. And the next slide, we're going to look at the breakdown of capital expenditure. So as we mentioned, aggregate capital expenditure has been ranged between 2 to 4% of GDP generally, but this has increased in the last few years to more like towards 6%. And what we've seen is that spending on gross capital formation, so the blue line at the top here, as well as other capital transfers, so the orange line, have increased since the late 1990s, which have driven this trend. So gross capital formation is that spending on typically fixed assets, for example, used in production by government for over 1 year. And we're going to talk through some of this in the next couple of slides as well, as to what's partly attributed to this. And also, interestingly, the orange line, which is quite volatile, as you can see, So capital transfers represent the cash payments by government to other subsectors of the economy to bolster the value of their assets. Now, what you can see during that spike in 2008, this was a period of the financial crisis, and government made substantial cash injections to acquire equity in the sector banks at the time, including the Royal Bank of Scotland, which later became NatWest, and the Lloyds Banking Group. And also in 2020, you can see capital transfers. But also we're going to look now at what's driven some of the recent increase in this orange line in 2023 and 2024. Next slide, please. So, as we can see, so the orange bars on this chart, the bars here show overall total government capital transfers, and the blue line explicitly shows the value of capital transfers to the Bank of England Asset Purchase Facility Fund. And what this shows is that central government payments to the Bank of England for losses on the Asset Purchase Facility Fund have led to an increase in capital transfers since 2023. So as you can see, the blue line here, so capital transfers to the bank for the APF were almost nothing in 2022 before spiking to almost 1.5% of GDP in 2023 and 2024. So one of the reasons for this is the movement in the bank base rate and the increases over time in this year. And this led to the value of the interest paid on the bank's reserves to holders of reserves increasing, and relative to the receipts that the bank received for the assets that it acquired during programs such as a quantitative easing, for example. And this led to outgoings increasing from around 1 billion in 2022 to around 36 billion in 2023 for the APF losses. Next slide, please. So this is a really interesting breakdown. It breaks down this expenditure in terms of what we saw before, so total expenditure by government, but this time through the lens of COFOG, so the classification or function of government as developed by the OECD. So some key things that these 5 lines show is that expenditure on the functions of government, so health, economic affairs, and social protection, having increased since the late 1990s. So if we're looking at the health, for example, the green line, that was below 5% of GDP in the late 1990s. And since 2020, this has typically ranged between 8 and 10%. And some of the things that that have changed over this time are rising intermediate consumption, so the cost of providing the inputs towards health provision in the NHS. And we should think about how the National Audit Office report changed in this context around over time in these years around the costs of providing specialist drugs and specialized services, but also the costs of filling labour gaps and acquiring nurses from agencies, for example. Also, the direct payroll costs, so compensation of employees directly employed, have increased as well, marked by increasing, in the trends over this include increases in salaries towards nurses as well as consultants. Social protection is an interesting one. It stayed broadly stable over time, but as you can see, there's the top line here, so ranging between, towards 16% of GDP by 2024. But if we're thinking of old age, for example, this has been one of the drivers for increases in these years. And spending on old age has increased as with demographic change, but also some implementation of policy like the minimum income guarantee, which later became pension credit, which increased average earnings by pensioners, which has been a key driver in recent years since 2000. Next slide, please. So there are other 5 other main classification of main functions of government. where expenditure has changed since the late 1990s, but this change has been far less than the 5 that we showed on the previous slide. I suppose the biggest one here is around the reduction in spending on housing and community development. Quite a complicated one, but it's quite hard. It's hard to disaggregate due to the changes in universal credit, which were implemented about this time. And on the next slide, I'm just going to wrap up some of the main points that we've covered in this presentation and in what we'll cover in the article. So total government expenditure in the UK has increased from around 38% of GDP in 1995 to around 46% in 2024, and this peaked at 52% in 2020 during the coronavirus pandemic. So current expenditure has been a key driver of this total increase, and this covers the cost of day-to-day costs of providing public services. And this has increased from around 35% of GDP in 1995 to 40% of GDP in 2024. And capital expenditure is an interesting one, as we've seen, but doesn't quite amount to as much of an increase as current expenditure does. And capital expenditure includes investment in fixed assets like buildings. And this has typically ranged, as we saw, between 2 and 4% of GDP until 2020, before reaching over 6% in 2024. And we've seen how this increase was linked to payments from government to other sectors of the economy, such as the Bank of England for the losses that it incurred on the APF, Asset Purchase Facility Fund. A couple of main points that have driven these increases. So government overall spending on health services has been a main contributor to these sustained increases in government expenditure. And also, while we've spoken about how expenditure on social benefits have been broadly stable over this period, there have been notable increases in some components, such as old age within this. We'll talk about these more in the article. That's my material covered. Thank you.
Hello, everyone. So I'm Nathaniel from UK Trading Goods at the ONS, and so I'm going to be sharing some of the analysis me and my team have been doing on the impact of US tariffs on UK trade. We released an article on the topic on the 1st of May 2026, and that's available on the site. So next slide, please. So before I get into the analysis, a bit of a brief introduction to the timeline and how we'll go about analysing the tariffs impact. So Trump introduced blanket tariffs on good imports to the US on April the 2nd, 2025. This covered almost all goods the UK exported to the US, and notable exceptions being steel, aluminium, cars and car parts, which were already subject to a 25% tariff that the president placed on these goods, and that was announced in March, but then only came into effect at the start of April. On May 8th, 2025, the UK and US announced the Economic Prosperity Deal with the overall aim of dampening the effects of the US tariffs on UK industries. One of the headline agreements was a reduction in the tariff on UK cars to 10% for a quota of 100,000 vehicles per quarter. And this deal came into effect on the 30th of June. To analyse the effects of the tariffs on UK trade trends, we selected 2 periods to compare. Firstly, we have what will be referred to as the pre-tariff period, which will be the 12 months to December 2024. This will be compared with a post-tariff period, which will be April 2025 to February 2026, ends in February, as this is the latest month that we had available data for at the time of the article's release. January to March 2025 weren't included in the pre-tariff period due to likely UK exporters likely bringing forward trade to the US and US importers stockpiling in anticipation of tariffs being placed, which may distort trends and weaken the usefulness of the analysis. So next slide, please. Just before mentioning anything, please note that all the figures quoted in this presentation will exclude non-monetary gold and other precious metals. This includes silver, platinum, and palladium, unless stated otherwise. Movement in these goods can be large and volatile, which distorts underlying goods imports and exports trends. So the value of goods exports to the US saw a large spike in March 2025, rising £0.8 billion, around 14.7% to 6.2 billion. This is the highest level of good exports to the US we'd seen since March 2023. And again, as previously I mentioned, we believe this is likely as a result of UK exporters bringing forward trade in anticipation of these tariffs. April 2025 saw a £1.5 billion, or around 24.7% drop in exports when compared to March 2025. And then compared to April 2024, it was a £0.8 billion drop, around 14.1%. The goods exports to the US have remained below pre-tariff levels ever since April 2025. The ONS's Business Insight and Condition Survey found UK exporters have consistently reported challenges associated with these tariffs. In late February 2026, 33% of UK businesses that export goods reported that they had been impacted by the US tariffs in the last month. 18.7% reported additional costs associated. The trade in goods balance with the US has also weakened since the tariffs were introduced. Exports have remained low, while imports have been on the rise since September 2025. This has resulted in the balance falling into a deficit since December 2025. Next slide, please. Now we'll move on to look at how specific export commodities have been impacted. So to quickly talk through the chart, so you have the blue representing the monthly average exports for the pre-tariff period, and the green representing the post-tariff period monthly export value. So on a high level, the chart shows us that there has likely been a negative impact fairly across the board on all commodity groups. Obviously, our largest export commodities are chemicals and machinery and transport equipment, and both have seen notable falls in both absolute and percentage terms. And we'll go into why that's been happening a bit more later. And then moving on to imports. Next slide, please. A bit more of a mixed picture, noting here fuels and machinery and transport equipment and chemicals are our largest import commodities from the US, and a bit more of a mixed picture. We've seen a fall in fuels and chemicals and miscellaneous manufactures, but then on the other hand, rises in commodities such as crude materials, material manufacturers, and machinery and transport equipment. Next slide, please. So on to the mentioned machinery and transport equipment exports to the US. So they have fallen by £0.4 billion since the tariffs were introduced. It's around 14.7% when comparing the pre and post-tariff period. And this fall was mainly due to a £0.3 billion fall in average monthly exports of cars. So this is around a 39.5% drop for cars. As previously mentioned, a 25% tariff was applied to the import of cars and car parts to the US in April 2025, which is very likely to have affected the UK exports of cars. The Economic Prosperity Deal attempted to reduce the impact of this tariff. Again, first 100,000 passenger vehicles exported per quarter, the tariff was dropped to 10% from 25%. However, car exports have remained below pre-tariff levels each month since then. Overall, UK monthly car exports have been falling by 0.7 billion to the entire world. This is not just the US here, 24.4% on average, with car exports to our other main export partners also decreasing in this period. Can you go to the next slide, please? To get a bit of a better graphic representation here, we've got a chart charting our 5 largest export destinations. So the US, China, Germany, Belgium, and France. So here, as you can see, as mentioned, in the aftermath of the tariffs being introduced in April 2025, a significant drop in the UK car exports to the US. However, other countries, including China, stayed stable or was even growing. However, following a cyber incident in September 2025, there was a drop in car exports of 24.5% in September 2025. Exports to cars to China fell 78.3%, and exports of cars to the US fell a further 47.2% compared with the previous month. This obviously means that the fall in car exports to the US is not entirely driven by the tariffs, and there will have been a significant effect, a large effect from the cyber incident. However, the chart suggests that maybe the US car exports have recovered to post-tariff levels, but pre-cyber incident levels. However, it does make it more difficult to ascertain the exact long-term impacts of the tariffs because the cyber incident had such a large effect. However, as the chart shows, the US does continue to be the main destination for cars exported from the UK. Next slide, please. Finally, we're going to talk quickly a little bit about chemicals exports to the US. So this is, as I pointed out in the exports commodities slides, this was the second largest export commodity we have to the US, and it also notably fell. So chemicals exports to the US have fallen by £0.2 billion. This is around 15.2% when compared with the monthly average for 2024. And this fall was mainly because of a £0.2 billion fall, around 16.2% fall in exports of medicinal and pharmaceutical products. Next slide, please. And then finally, a little bit of a graphical representation. So the fall in exports of medicinal and pharmaceutical products to the US may be linked to the US government's easing of regulations to promote domestic pharmaceutical production, as was announced in an executive order on the 5th of May 2025. And that's all from me. Thank you. Oh, apologies. I'll quickly run through a final summary. I completely forgot that. So apologies about that. So yeah, I'll sum up here. So the goods exports to the US, excluding precious metals, fell by £1.5 billion in April 2025 compared to March 2025, following the introduction of tariffs, and have remained below pre-tariff levels since. Exports of cars to the US fell in April 2025 and have also remained below pre-tariff levels since. Exports of medicinal and pharmaceutical products have also fallen since April 2025. Goods imports from the US have risen since September 2025 and have exceeded exports for 3 consecutive months since December 2025. And the US remains our largest goods export partner and our third largest goods import partner. Thank you very much for the second time.
Thank you very much to all our speakers there.